Thank you. Today's session on student debt is sponsored by the National Endowment for Financial Education, and I would like to introduce you to its CEO and president, Ted Beck. NEFI has been a supporter of CEBU for 8 years now, and we're very glad to have them as a partner. Ted recently served as appointee to President Obama's Advisory Council on Financial Capability, and prior to that, he was on the Financial Literacy Council for President Bush. Ted also serves on the FDIC Advisory Committee on Economic Inclusion and is chairman of the Jumpstart Coalition for Personal Financial Literacy. We are very proud to have him here with us today, and I'd like to introduce you to Ted Beck.
Thank you, Jill. For those of you that don't know NEFI, we're a nonprofit organization that is solely focused on improving the financial capability of all Americans. And we do that through research and data gathering, and one of the things I think we're most proud of is our relationship with CEBU. We have had this relationship for about 8 years now, and we've been able to actually sponsor this panel or its equivalents in the last 4 sessions because we provide a lot of data to your membership and unbiased sources that hopefully you can turn into great stories. We're also very pleased to be holding this at the George Washington University. Many of you probably know, but those of you who don't know, actually one of the top centers for financial education in the country happens to be located here. It's the Global Center for Financial Literacy, and Dr. Anna Lusardi, who is here in the red, is the head of the center, and who is in our book probably the top researcher and academic expert on personal finance issues in the country. So if you call us and we say, gee, we're going to get back to you, it's because we're taking the time to call Anna and find out what the real answers are. So congratulations for doing this here at the George Washington University. Today's panel is something we're very interested in. The whole idea of student debt has gotten great press over the last year just because of the magnitude of it. But we also think there's some very critical underlying questions that hopefully the panel will be able to get at today. Issues like what is the difficulty in finding jobs, how are they affecting graduating students, the issue of for-profit schools and how that's skewed the numbers. And possibly the biggest single issue that we're concerned about is not the student who graduates with $27,000 in debt, but the student who doesn't graduate and still has the debt. So some very, very significant meaty issues to talk about, and luckily you have an outstanding panel here to do it. And our moderator is Kathy Kristoff, well known to all of you as an author, a columnist, and a past president of CEBU. So Kathy, it's your show.
So I organized this panel because I felt very strongly that we as journalists and as parents were involved in the conning of America's children. We told them that college is an investment. Don't worry about going into debt for this. We told them that you can go to any school you want. We'll make it work. We didn't tell them that your major is going to have a big impact on whether you can repay your debt. We didn't tell them that there are differences of types of student debt. And to be fair, we didn't know. In a lot of cases, the reason why we conned our children is because the whole student debt issue has changed so much in the past 20 years that we as parents had one experience and the experience of our children is completely different. So I got together a panel of people who can talk to you about really all aspects of student debt and how debt is different. One of the things I'm going to stop because I was talking to Becky Bisbee who before this, and she said, "Okay, Kathy." I said, there's so much to say, and she said, "Kathy, they're not here to listen to you." She goes, "It's like, okay, we have a program. We know who all these people are. It's very impressive. We want them to talk." And so I'm going to make it very quick. I have Jane Bennett Clark from Kiplinger's. She not only is an expert on student loans, on colleges. She's also a parent and has had these experiences herself. I've got Pauline Abernathy with TICAS, who is one of the world's greatest experts. Actually, both Pauline and Stephen Burt are the incredible experts on a broad array of the differences in the types of debt, your repayment options, and also the incredible number of legislative efforts that are being made and consumer protection efforts that are being made in the student debt arena right now, because the debt is truly unique and actually among the most toxic forms of debt we can get our kids into. So without further ado, I'm going to introduce you to Jane Bennett Clark, who's going to come on up here. And just so you know the program, our speakers are going to come up and speak at the podium for a few minutes, and then we're all going to sit down and hopefully answer your questions. Okay, Jane, thank you.
So, as Kathy says, I have been covering college financial aid. We also have annual rankings that we've been doing for about a dozen years. And so we've been focusing on the value, we've focused on net price, and we've focused on average debt for about a dozen years. We also try to explore the decision-making process that parents go through as their kids are applying for college and choosing a college. And I've kind of concluded, as both a parent and as a financial reporter, that the admissions process as well as the financial aid process really encourages parents to make an emotional decision about borrowing. And here are some of the reasons why. First of all, families, as Kathy mentioned, put together their college list based on academics, academic qualifications. And oftentimes they're kind of aspirational lists. It's like, well, maybe my kid can get into this school. They tend to sort of focus on the reach schools. And they don't really focus on the financial aspect of it. They start with the academics, and they put that list together from that point of view. And then the colleges actually encourage them to just wait to see what you get, especially when it comes to merit aid. I mean, you can go on the college websites and check out the net price calculators, but you're really not going to know what kind of merit aid your kid would get. So, and I can tell you that I've done this myself. I have 3 kids, they're all through college. And so you get to the point where your kids are getting these letters. And I have been in the room when my own kid has been like jumping around saying, oh my gosh, I got into the school, I can't believe it, I'm going to the school. And I'm thinking to myself, yeah, and the other school was the one that we could actually afford. So now it's like, well, yeah, I guess we're going to send her to this school. Like, yikes. So then you're just primed for the next decision, which is, well, how the heck am I going to do this? And what happens is, first of all, the financial aid letters sort of convey the idea that they are doing you a big favor, that they're actually presenting you with this financial aid award that is actually largely loans, basically inviting you to take out a loan. And I can tell you that this has happened to me because my daughter, we got the financial aid award letter, and it congratulated us, telling us that we had the opportunity to take out 100% loans to cover the cost. We were going to get to take out a plus loan, and on top of whatever unsubsidized Stafford loans that we were entitled to begin with. So it's a very misleading situation, and it's a very emotional situation. I mean, here you are. Your kid has gotten into the school of his or her dreams, and you want to make that kid happy. You're excited. So there you go. And these loans are easy to get. I mean, you can get a Stafford loan pretty much with no underwriting, nothing. And plus loans, you know, they have gotten a little harder to get, but basically pretty easy to get. So parents are ultimately signing up for these things, and the kids are too. So, you know, people have a responsibility to think about it. I mean, you need to start when you're putting the college list together. And then you have to think about it again. You have to talk to your kids and say, you know, what can we really do if we don't get the aid? So I think there is a level of responsibility for the families too, that you can't blame it all on the colleges. I think families get set up for this, but they do play a role in this decision-making process. So,
We'll go to Pauline Abernathy. My plan with my children is I told them, really don't study that hard in school. If you get into a junior college, that'd be great. All you parents, all you tiger moms, you know, you're going to pay for that. Anyway, Pauline, sorry.
So, thank you for inviting me to speak here. With the Institute for College Access and Success, TICAS, we're based in Oakland, California, have a small office here in DC. All of the things that you just heard are absolutely true. And one question I get often from many of you is, how could this be? How could it be that the award letters don't actually distinguish between loans and grants? How could it be that we expect people to apply before they know how much aid they'll be eligible for? How could it be that we don't explain the difference between a federal and a private loan? And the answer is, when I went to college, when many of you went to college, it was an entirely different world. Private loans barely exist. College did cost much less. You could actually put yourself through college working during the year and on summers. The world has changed, and college wasn't as essential then as it was today for everyone. So we've got a dramatically different world today, and our policies and practices have not changed. We have the same policies in place when fewer people went to college. College cost much less. The financial situation was very different. So we're in a process of major catch-up, of changing our policies and practices to actually reflect the new world. So just a little bit of context. You all have no doubt heard we have now more than $1 trillion of student loan debt outstanding. That's more than car loans or credit card debt. That includes both federal and private loan debt. Students are indeed borrowing more. When I went to college, a majority of students who graduated with a bachelor's degree from a nonprofit or public college did not borrow. Today, 2/3 of them borrow, and they borrow an average of $27,000. Again, that's federal and private loan debt. You hear a lot about students who are borrowing $100,000 and graduating from college with $100,000. Those really are the outliers. There's less than 1% of undergraduates borrow that much. The average, again, is $27,000. A third aren't borrowing anything in student loans. But you do see more and more, and we'll be later this year, there'll be new federal data on federal loan borrowing, which will be a major development on, but the latest data we have is still for, in many cases, for 2007, 2008. And what that showed at that time was about 10% of students were borrowing more than $40,000. So, and those students were highly concentrated in the for-profit college sector. A majority of the students who graduate from for-profit colleges have both federal and private loan debt, and they have a much higher level of debt than those in the nonprofit or public sector. What we say often is it's not just how much you borrow, it's how you borrow, and if you complete, to your point, your ability to repay is much greater if you have completed school. And what people don't realize is their chance of borrowing and completing varies dramatically based on which school they go to. It varies by sector, public, nonprofit, and for-profit, but even within those sectors, there's huge variations in terms of what the cost actually will be, what your likelihood of borrowing anything, your likelihood of borrowing private loans, and your likelihood of completing. And so we need to be providing much better information to families up front so they can make better decisions about where they apply, where they enroll. Right now, in fact, some of the key data you would expect in order to make those decisions is simply not available. It's not just that it's available to experts in a hard to find place. A lot of it just simply is not available. So what do I mean by that? The federal government does not collect the average debt at graduation by college. So we at TICAS every year put out an annual report on student debt for the class of, well, the most recent one was 2011. We'll come out with 2012 later this year. We use a private data set that we buy access to that colleges voluntarily participate in to come up with that data and then put out state data and school-based data. But that data should actually be required to be reported and collected and made available. As a result, because it's voluntary, the for-profit colleges, virtually none of them participate. So essentially that is a study of nonprofit and public colleges, and only those who choose to participate. And each year, sometimes when we highlight those that are high-debt colleges, they disappear the next year. They're not on the list. They don't report. So that is kind of basic data. The administration has put out a college scorecard that has on it completion rates and debt information, which is a step forward to say, here's a one-pager that has some basic information about this college. But the completion rates aren't for all students. They're only for first-time, full-time college students, which at a lot of colleges, particularly community colleges, for-profit colleges, that's a very small percentage of their students. So it's not a real graduation rate. It can be very deceptive. Likewise, the debt data on that scorecard is the median debt of those who entered repayment. So it's the median debt of those who graduated and those who dropped out. And it also doesn't tell you what percentage of the students actually borrowed. So again, it's not the information that most families want and need to make good decisions about where to apply. But it is a huge step forward. I'm alluded now a couple times to private loans versus federal loans. Federal loans, the terms are set by the federal government. They have fixed interest rates. They have a whole host of consumer protections and an array of flexible repayment plans, including income-based repayment, which allows you to repay as a share of your income so that your payments will always be manageable. And if after 20 or 25 years you have not repaid in full, the balance is forgiven. There's discharge of the debt if you become disabled. There's a host of protections, none of which are guaranteed in the private loan world. Private loans are literally the riskiest way to pay for college. It is like paying for college with a credit card. They're usually variable, uncapped rates. There are some fixed now, but they're typically variable, uncapped. You have very little repayment protection or options, and they are considered non-dischargeable in bankruptcy. They're very difficult to discharge in bankruptcy, unlike credit card debt or even gambling debt, which are treated. That is one of the issues that we and a large coalition, and there's legislation pending in Congress to change that treatment of private loans to say they should be treated just like other forms of consumer debt, not like alimony or criminal fines. So again, it's not just how much you borrow, but whether you're borrowing federal loans, whether you're borrowing private loans. In terms of what can be done, so just very briefly, and then I'll turn over to Steve to leave room for questions. We have a whole agenda to reduce the burden of student debt on our website. So I'll just talk about a few key issues that can be done to address this. One is the federal student loan policy. So as many of you know, the interest rate on subsidized federal loans is scheduled to double again this July 1st, from 3.4% today to 6.8%. From our perspective, it makes no sense at a time of record low interest rates to be charging 6.8% on federal student loans. But that's exactly what will happen if Congress does not act, that they will automatically double. There's also the issue of the doubling of them will make it more likely that we'll see students turning to private loans when they could have borrowed a federal loan, because they'll say, well, this federal loan has a 6.8% interest rate. This private loan, the bank's saying that starts as low as 2%. And won't appreciate the difference between a variable rate and a fixed rate and the differences in the types of loans. And so we already see, even at the height of the private loan market in 07, 08, half of private loan borrowers could have borrowed more in federal loans. So you can imagine what we would see today if we suddenly saw all the federal loans at 6.8% and private loans being advertised aggressively as low as, meaning if you have perfect record, that will be your interest rate today, but it's going to go up each month as interest rates rise. And if your credit record or your parents' credit record, because private loans require a co-signer If their credit isn't perfect, then it's not going to be that low even today and will only rise over time. So it's addressing the federal student loans. It's making sure that borrowers know about income-based repayment. We've got rising student loan default rates in this economy, and many of those borrowers could have avoided default if they were aware of income-based repayment, which only became available in 2009. So we need to see a lot more outreach to let people know that income-based repayment is there and available to them. We also need better loan counseling up front so that when a student's making a decision about how much to borrow, they understand what that's going to mean to them in terms of monthly payments. And if this is their first year and they're going to be in school for 4 years, that means 4 times that amount. And really helping them through that. The Department of Education, to their credit, just did release a new loan counseling tool with an online repayment calculator. It's long overdue. It's a step in the right direction of helping borrowers make better informed decisions. And specifically during the counseling that's required when they're leaving school, it allows borrowers to, as part of the counseling, pick a repayment plan. So they can literally see what their monthly payment will be, what their total payments will be under each plan, and then pick one right there and apply online. So that's, again, an important way of helping them pick the right plan for them and get into it rather than defaulting into a very expensive high monthly payment plan, which is the current policy. So I already talked about the need for better consumer information. We've got net price calculators that help people get a sense of what is the real price to them, not the sticker price, which very few people pay the sticker price. So every college now has a net price calculator. There's the college scorecard we already talked about. The administration has put forward a model award letter they're calling the shopping sheet, and more than 500 colleges that enroll more than 10% of students have agreed to use them for the first time this year, and it will distinguish between loans and grants. It will actually make clear what is the net price, what is the price you pay after grants that you have to either earn, save, or borrow. That is not the case with most award letters today. There's bipartisan legislation pending in Congress that would require all colleges to use that kind of a standard award letter so that families would have an easier time comparing the offers. It's not easy even for someone like myself to look at award letters currently and actually determine which is a lower cost college because of the way the information is presented. Two other private loans, I talked briefly, changing the bankruptcy treatment. We also need to be requiring that all private loans be certified by the school first to ensure that the student is actually qualified for that private loan, and to ensure that the school can tell the student, hey, you're taking out a $5,000 private loan. Did you know you could take out a $5,000 federal loan that has these consumer protections? Some schools do that voluntarily right now, but it's not required that the lender check with the school, and it's not required that the school tell the student how much remaining federal loan availability they have. And so that's something that also there's legislation pending. It's something that the Consumer Financial Protection Bureau could just move forward to require as well, which we have been advocating for. And equally important, for the millions of private loan borrowers who have private loans today, many of them with interest rates in the double digits. And really, they're saying, we hear from borrowers, the Consumer Financial Protection Bureau hears from borrowers saying, look, I'm willing to pay $100 a month, but they want $500 a month. I don't even make $500 a month. And they can't get any relief from their lender or any flexibility. The loan's not dischargeable in bankruptcy. So one of the things that is also pending next week is the deadline for commenting on a request for input from the Consumer Financial Protection Bureau on suggestions for how could we develop a way to make private loan payments more affordable. What kind of a loan modification system, what other types of relief would help address what they've seen in the complaints they've received and in the data they're showing, where we've just seen lots of people who are going to not be able to buy a home, not participate fully in the economy as long as they've got that kind of unmanageable private loan debt hanging on over their head. And then finally, to end, the last item that is critical for reducing the burden of student debt is funding Pell Grants. Pell Grants are need-based grant aid. It's the largest core program that the federal government has, and even after the recent increases in the maximum Pell Grant, it covers a smaller share of the cost of a four-year public college than it has since the program started. It's less than a third, and it used to be well over half, well over two-thirds. And I can, during Q&A, I can talk a little bit about why that is, but we need to be investing in Pell Grants. It is the key to reducing the need to borrow, particularly for low-income students, and Pell Grant recipients are actually twice as likely to borrow today as non-Pell Grant recipients. And Pell Grant recipients who graduate from a four-year program, 9 out of 10 of them have student debt. So they're much more likely to borrow, and in fact, they also graduate with $3,500 more debt than the average non-Pell Grant recipient. So we are already expecting the lowest income to take on more debt, and that will only get worse unless we are able to invest in Pell Grants going forward. Thank you.
Thank you, Pauline. I want to actually have you sit down up there, and Jane, you too, because after Steve speaks, we're going to go to questions, and I just don't want to take extra time getting us all situated.
Hello. I hope everyone is doing well. Jane scared me a little bit because I've got 2 little kids. So I'm trying to figure out how much debt that's going to be in about 15 years from now. Is very frightening. And if I have to tell them, I'm already telling them that Montgomery College, I live in Montgomery County in Maryland, is the way to go. So my name is Steve Bird. I'm with the New America Foundation. We're a public policy think tank in Washington. Before coming to New America, I was a reporter at the Chronicle of Higher Education for 15 years. I started covering student loans in 1995, and the changes that have occurred over that period of time are just amazing. At that point, very few undergraduates were taking out private student loans. In fact, I never thought about covering them at that point because you just didn't hear about them. So it was a surprise even to me when, about 10 years later, you started hearing these horror stories about undergraduates with these loans and how aggressively lenders were marketing them. So I wanted to talk a little bit from the student's perspective on this, but I just wanted to start off by saying the federal government has subsidized loans to college students for nearly 50 years. When the government's main loan program, the Stafford Loan Program, first began, it was intended mainly for middle-income students to help them to afford to go to the college of their choice. As late as the early 1990s, less than half of all bachelor degree recipients were taking out student loans. Today, 2/3 do, and as Pauline said, that with an average debt of about $27,000 per borrower. Overall, students and parents borrow an estimated $112 billion a year through the various federal loan programs. In addition, students are borrowing nearly $10 billion a year in risky private loans, which, as Pauline said, are almost always more expensive and less consumer-friendly than federal loans. Student loans have long been considered a good investment, providing individuals with the means to obtain an education that would pay dividends, pay substantial dividends throughout their lifetimes. But it's become increasingly clear that many students are finding themselves with unmanageable levels of debt that could hamper their future life choices, such as getting married, buying a house, having children, and retiring. If you want to get a sense of the significant toll that our student loan policies have had, you just have to look at some of the comments that financially distressed borrowers have submitted to the Consumer Financial Protection Bureau recently. I was looking at their site the other day, and I came upon one borrower who has a very substantial debt load wrote, "Even with the income I generate from working 2 jobs and my wife working 1 job, we cannot afford many things because the amount we must pay each month to the student loan companies. We cannot afford health coverage, which in turn limits our ability to start a family. As we both will turn 30 this year, we feel that time is running out for us to be able to reach our personal goals and dreams." Another borrower who pays over $1,600 a month on his federal and private loans wrote, I will never own a home because of this crippling debt I have faced since I graduated college. I can't even buy a car because I can't qualify for a car loan. I drive a 2000 Honda Civic that will die on me someday, and I have no idea what I will do. Do these borrowers make mistakes? Certainly, and they readily admit it. But what kind of system requires teenagers at the ripe age of 18 to make financial decisions that could have such a life-altering effect As another borrower wrote, "Coming out of high school, I didn't realize that taking on this much debt could affect me this much financially. I just wanted to get away from home and get an education." Students and their families are generally left on their own to navigate a complex student loan system. Offers a variety of choices, each with different interest rates and loan limits. Yes, the Education Department requires colleges to provide entrance counseling to students, but it often comes too late in the process, after borrowers have already committed to taking out the loans by signing their promissory notes, and it's often perfunctory. The first weeks of college can be overwhelming, and the last thing that many students want to do is focus on the details of their student aid packages. Federal student loan borrowers also face a baffling array of repayment options. The government offers financially distressed borrowers various ways to stay out of default, such as forbearance, deferments, and income-based repayment. But these choices all have their own rules and regulations and require borrowers to actively take steps to enroll and stay in them. Unfortunately, many borrowers simply don't receive the kind of counseling they need to understand the choices that are available to them or what they need to do to take advantage of them. Once students leave college, they're truly on their own to sort these things out. As a result, many borrowers unnecessarily fall behind on their payments and end up defaulting. The consequences of defaulting are severe, ranging from ballooning repayments to ruined credit ratings and the loss of professional licenses. Federal policymakers have made it much more difficult for borrowers to discharge their student loans in bankruptcy than any other form of consumer debt, and have removed any statute of limitation on the collections of these loans, allowing the government to literally unleash an army of student loan collection agencies who can pursue defaulters to the grave. They have also empowered the government to garnish the wages of defaulters without a court order and seize tax refunds and other federal benefits, such as portions of Social Security payments from elderly and disabled borrowers. It's certainly unacceptable for students to take out federal loans without having any intention of paying them back. The reality, however, is that many, if not most people who default on the loans do so because they simply don't have the money to repay them. They are not looking for a free ride. Yet our system for student loan collection does not recognize this crucial distinction. Borrowers who deliberately skip out on their loans and those who are too financially distressed to repay them are subject to the same harsh treatment. Many lives are ruined as a result. So what can we do to, what are some of the steps that we can take? Pauline Tikas really has some really great ideas, and I would definitely recommend that you go to their website. One of the areas that they are really, that some ideas about better loan counseling have really impressed me, and I would definitely suggest that. We believe at the New America Foundation that there should be a single loan program for undergraduates with the same terms and conditions for all borrowers, and that income-based repayment should be the default repayment option for students, meaning that students would automatically be enrolled in the program, which would allow them to pay back their loans as a percentage of their income after they graduate. Such a system would recognize that some people just simply don't earn enough to fully repay their loans, no matter how earnestly they try to. As I said, loan counseling needs to be strengthened, and Congress needs to make private loans dischargeable in bankruptcy like all other forms of consumer debt. Only then will private loan providers have any incentive to work with financially distressed borrowers to ease their burdens through loan modifications and refinancing, options that are generally not available today. I'm going to stop there, and I look forward to your questions.
Thanks, Stephen. Before we go to question and answer, I just have a couple questions for the audience. How many people are here because you have children who have debt and you really just want personal? Okay, great. How many people here are looking for a way to cover, student loans, college, all that stuff? Great. I want to throw a couple of ideas at you because there's so many things that I think could help us raise the bar in how we cover college. One of them is every one of you have local colleges in your neighborhood, and you can find out just exactly how good they are at graduating kids in less than 6 years, which has a huge impact on how much you pay for college, how much debt the kids come out with at the end of the school, and whether they graduate kids at all. Some of the private colleges, if you go to the College Navigator site, it's collegenavigator.org, .gov, sorry. If you go to the College Navigator site, all of this data is there and it's on Mind. And if you want to do a comparison of all the colleges in your little area, I think it would be the most incredibly mind-blowing thing to your parents, readers, because you would suddenly see, oh, look at this college that my son wants to go to that is charging $40,000 a year. They graduate 10% of their students. If you are one of the 90% who don't graduate and you borrowed for that education, your chance of being financially devastated for the rest of your life is huge. There are step-by-step tutorials that I think we could do a much better job of doing just on, what do you do when you graduate? 5 tips for, paying off your student loans. But again, I think some of it is just all in your local neighborhoods. Look at your individual colleges. Go in and compare, like what the administrators are making versus what they're charging college. Compare how much they give to needy students. Compare their award letters. Hold their feet to the fire, because in fact we've been too easy on schools. We've acted as if they were giving our kids something so valuable, and actually we've acted like they're a commodity. We don't do a great job of comparing one school to the next, and the differences between schools are actually life-altering. So with that, I'm going to go to questions. Yes, come on up to the microphone.
Hi, I'm Karen Miller. I'm a SABU member from Reading, Pennsylvania, Reading Eagle. My question is, why do you think colleges don't make a greater effort to reduce their price? Has anyone tried to itemize exactly what goes into the cost of college in a year, and why wouldn't they want to make their product more affordable?
Do you guys, I'm going to say they don't have to, but go ahead. Stephen, there's a microphone right next to you.
So, if you look at, I have 2 different answers to that. One is called the Chivas-Regal effect, which mainly affects private colleges, I would say, but also some of the some publics, where basically it just lowering prices makes you look bad in the market. You don't want to look like you're a discount, that you're discounting the education that you provide. So colleges, there's a great pressure to keep up with the competition and to continually look more expensive, which is just strange. But then the other aspect for public colleges is a lot of schools don't really have a choice they have choices, but the states have just been cutting the amount of money that they provide these schools. And so the easiest way to deal with these cuts is to raise prices.
Well, I do think that there is an issue with, there's kind of a backwards way of approaching it, because colleges they do have to give out a lot of financial aid and oftentimes merit aid or tuition discounts in order to fill the seats. But then that means that they have to raise tuition to cover the people that aren't getting that aid. It's just like, it's kind of a vicious cycle in that, sure, many people don't pay the sticker price, but somebody's got to pay the higher price. And this whole issue of enrollment management is such that colleges work very hard to figure out exactly how much you will be willing to pay to come to their college. And they will give you just enough to get you in the door, but not necessarily as much as you can afford to pay. So it's just like this very kind of situational type of financial model that
Think of them as auto dealers. You know, you walk into the showroom, they size you up. Well, how much will this person pay for the Mercedes? That is what they're doing to you with college. They really are. And if you go in and your kid is so set on Georgetown, not that I'm speaking from experience, you know, you're just going to find a way to let them go to Georgetown. And that's the thing. If they figure they don't have to give you aid to get you in, then they won't give you aid to get you in. The other thing, too, is when you are telling your kids to apply to all the REACH colleges, the top of the list is less likely to give them any sort of aid. It's the colleges that they totally fit into their profile that are more likely to get them aid. And if they go to a college that is a little under their, you know, their status for grades and SAT scores, those colleges are going to give them a lot of aid. Where do we tell them to go? Top of the list, right? So we're part of the problem. Oh, sorry.
Yeah, no. The car dealer analogy is actually, I think, a very good one in that for more than 50 years, we've had those sticker sheets and the window sheets that have been required by federal law on cars. We're only now debating doing that for colleges with these standardized award letters. But that's how far behind we are, but it's exactly the same idea of allowing, helping consumers make an informed decision. Really want to underscore, you know, Steve's point that what's driving the cost and why you don't see a lot of reductions in price, although we're seeing more. In the last few years, you're seeing many more colleges saying they're freezing tuition, they're lowering their tuition. But the key, it really varies by sector. For-profit colleges set their prices very differently than public colleges, which are primarily driven by their appropriations and the withdrawal of state appropriations. Nonprofit colleges, yet again, a different factor, and depending on their level of selectivity, different factors go into account in how they set their prices. But also want to underscore the point that, you know, everyone needs to be looking at net price, not sticker price. The college with the highest sticker price will often be the most affordable, particularly for low-income students. You know, they're going to go to Harvard. If they can get into Harvard, they're going to go for free. They're going to get much more aid than they would at a local college that might be public or nonprofit, have a much lower sticker price. So we need to get people, help readers understand that it is net price, not sticker price. You need to look beyond, and there now are some tools to help people do that.
Hi, I'm Colin Campbell. I'm a student, as it were, at the University of South Carolina, and we've written about this with the student newspaper, the Daily Gamecock, a good deal. And one of the things we wrote about, obviously, the doubling of the student loans, federal loans, has come up a couple of different times and keeps getting, you know, pushed down the road. And one of the things that we noticed when we're, you know, obviously you want to try to source and get people who are on both sides of that argument, and people who are proponents of, you know, that thing doubling, their argument is, well, we need, you know, how else are we going to put our foot down on the colleges? And you know, if you make that loan rate double, then colleges are going to have to bring down their prices. You know, it's going to really, you know, put their feet to the fire, like you were talking about. You know, if it stays low, which, I mean, I think I agree that it needs to, but if it stays low, how else do you keep their feet to the fire? What else can you do to force them to do that?
Well, I think the interest rate, it doesn't actually do that for colleges. 80% of the students who take out subsidized loans that have the 3.4% interest rate have unsubsidized loans as well. So they're already paying 6.8% on their loan. So they're already taking out both 3.4 and 6.8% rates. So it's not had the impact. I think the only people who benefit from student loan rates doubling are the private lenders.
Hi, Amy Zipkin, SABU member, freelance journalist. I was wondering if any on the panel could address the FAFSA and the parent's obligation in the FAFSA, because when we did it, and we did it in the spring of '08, which was very different than the fall of '08, we came up with a very different number. And the schools were recalcitrant in their negotiating ability on this number. And, we kept on scratching our heads because it was based on really parents' income. I mean, if the student had, $1,000 or $2,000 worth of savings from a part-time after-school job, it seemed that the schools were expecting the families to go out on a limb based on an income level that would never be the student's.
The FAFSA forms have changed actually dramatically since 2008. They're a little bit easier to negotiate right now. But one of the things that you should do is get Cal Chaney's book, Paying for College Without Going Broke, because it actually takes you step by step through the FAFSA form. And there are a lot of mistakes that parents make on that form because normal English is not how it's written. And so if you read it, or in particularly if you skim through it because it's like, massive and you don't want to read all 300 pages of the instructions, you are likely to make some very costly errors. And that book will lead you through how to do that without making those costly errors. But it actually is a little bit easier than it used to be. We're being told that we need to wrap up, so I'm going to just have you guys go as fast as you can, and we're going to try and answer as quickly as we can until they kick us out.
Hi, my name is Oliver St. John. I'm a small business reporter for USA Today. I graduated from college last year, and out of almost all my friends, I was the only one. I'm the only one who's not working at I don't know, Brugger's Bagels or something, and a lot of my friends are wondering, God, was this worth it? I don't know if when I made this decision, if this was something I should have done when I was 17 or 18. And this, not to say that my parents should have made it for me, that would probably have been even worse. But maybe I should have taken some time off, done something else. Nobody really knows. Are there other options to, I don't know, help you make that decision better? Or do you have to make it when you're 17 years old?
These are one of the things that I think would be so great if we helped counsel parents in the newspaper and on TV. If we gave them a little bit of emotional support for saying to your kids, seriously, junior college is not such a bad option. Taking 2 years, getting your undergrad done someplace where you're not going to have any debt, not a bad option. In my community, there's a lot of Mormon families. Their kids go on a 2-year mission, and they come back so much more mature and ready to go to college. And instead of failing in their freshman year, they actually study. Okay, and then they don't have to take classes. I can't. The number of kids who take 5 and 6 years to get through college is phenomenal, and some of that is, I think, the maturity of the student, how prepared they are really for college. But as parents and as journalists, we don't present that this is a really good option for kids. Don't just go down this path because all of the parents in your neighborhood are talking about Harvard and talking about Princeton and talking about all these places. Don't be pushing your kid to go to something that as a parent they're not, ready for. But sorry.
I would just add to that the research is really clear, the data is very clear. The unemployment rate for those who don't go to college is more than twice as high as those who have a college degree. So on average, it is a much better, it is a good investment. But people need to be look much about where they go to college. Do they go and take 6 years, or can they get it done faster because that's going to have significantly less debt? And what are they studying? And to think about those things more carefully.
I'd also like to add that one of the things that you want to think about in terms of whether it's worth it is how much did you borrow to get the degree. And if you borrowed maybe $10,000, $5,000, maybe it is worth it at the end of the day. But if you borrowed $40,000 or $50,000, then I would say, yeah, probably not worth it.
And in some schools, particularly in community colleges, there are students who probably would be better off if they were taking out a loan than trying to work 2 jobs while going to school, because their chances of completing are so low if they try to do it without borrowing anything at all. And if they took out that one loan to help repair their car so they could get to the campus, they'd have a better chance of completing, and that would be a good investment.
Okay, unfortunately, Warren is telling me that he's going to send in the Cebu bouncers if we don't get off this stage. But I'd like to suggest these guys will stick around for a little while and can answer questions one-on-one. They're incredible resources, so if you cover this topic or if you want to cover this topic, come up, get their contact information. Thank you very much.